structured finance, origin, and popular products. Before we start with the different types of structured finance products, let us understand a brief history of structured finance products and how all of this started. The first process was securitization, which began in the United States in the early 1970s. This process meant using pools of mortgage loans and saw rapid development as government-sponsored enterprises backed it. In the whole 1980s, Fannie Mae, Freddie Mac, and Ginnie Mae issued pass-through securities, which eventually led to a marketplace for consumer-based asset-backed securities in the United States. Here, the investors could buy and hold a prorated share of a pool of mortgages. The private label mortgage-backed securities had also become a good financial instrument, but they only started to become more popular after the 1980s. In 1983, Fannie Mae and Freddie Mac issued the first structured securitization called Collateralized Mortgage Obligation. This financial instrument lets government-sponsored enterprises sell a series of complex securities with different repayment properties. During the mid-1990s, the securitization of subprime mortgages started to become more visible in America with the changes in the design of mortgage contracts. The shares of mortgage-backed securities by subprime loans exponentially increased between 1996 to 2006. Over time, the financial institutions discovered that pools of risky tranches could also be used to create collateralized debt obligations. In the year 2000, investment banks began to utilize this group of techniques by mixing lower-rated tranches of mortgage securities. Now that we have discussed a short history of the structured finance industry, let us start with the different types of structured finance products. But hold on, let us understand these products with a simple example to understand how the risk and return profiles get altered. Okay, so meet Eric, an investor. He makes a $10,000 investment in a 40-month prepackaged structured product. The $8,000 goes into an investment-grade bond, which yields a 7 to 8% annual return. The remaining $2,000 go into stock indices. Eric may earn approximately $2,000 in interest on underlying assets for 40 months. In the due period, the indices will have doubled, and the $2,000 invested in it will become $4,000. So, this means that Eric's $10,000 will be worth $14,000 at the end of maturity, offering him a stunning 40% absolute return. This means that Eric may rest assured that his $10,000 investment is safe at the same time. If the indices prices decline by half, his investment of $2,000 will become $1,000, ultimately resulting in a return of $11,000. Now, this strategy protects Eric's capital at all times and ensures that he will receive $10,000 at the end of 40 months. Now, we believe this example explains a simple part of how structured finance products work in capital markets. So, without any further delay, let's understand the different types of structured finance products in the market. The first one is the mortgage-backed securities. By definition, a mortgage-backed security is a financial instrument backed by collateral in the form of a bundle of mortgage loans. The investors benefit from periodic payments encompassing a specific percentage of interest and principal. However, they also face several risks like default and prepayment risks. There are many government agencies or sponsored enterprises, central banks, and private investment banks that can issue mortgage-backed securities. Some of the major players backed by the United States government are Ginnie Mae, Fannie Mae, and Freddie Mac. They play an essential role in maintaining liquidity in the mortgage market by purchasing mortgages from their originators. A mortgage-backed security is a bond-like security created by bundling mortgages. Banks connect property buyers, usually clients seeking home mortgage loans, and investors. This simply means that the borrower's monthly payment against the mortgage will ultimately reach investors, and the impact of certain events like default in payment, interest rate fluctuations, and prepayment will fall on the investors, not the intermediary banks. We all remember the issues caused by the 2008 financial crisis. That said, still, investors are still attracted to mortgage-backed securities, and the Federal Reserve currently holds a large portion of the mortgage-backed securities to protect its economy. Who creates them? They are created when a large bank or any particular financial institution buys mortgages from banks, issuing them and organizes the collected mortgages in different bundles to form a financial instrument. It has one subtype, which is called the pass-through mortgage-backed securities. A pass-through mortgage-backed security is observed as the most traded fundamental form of financial instrument in the secondary market. The instrument is designed as a trust with a cash flow from the collateral pool passing through in the form of monthly principal and interest payments. Such instruments reside either in the form of commercial or residential mortgage-backed securities. Moving on to number 2, we have the asset-backed securities. Asset-backed securities are financial instruments representing claims on underlying assets like mortgages, auto loans, or credit card receivables. These assets are bundled together and sold as securities, allowing investors to gain exposure to the cash flows generated by the underlying assets. The creation of asset-backed securities involves securitization. In this process, individual loans or assets are pooled and transferred to a special purpose vehicle, which we have discussed in the last module. Such financial instruments help in managing risk and enhancing credit quality through over-collateralization, reserves, and third-party credit enhancements. When an asset-backed security is created, it lets large institutional investors invest in higher-yielding asset classes without any form of additional risk. It also aids in raising capital without accessing primary markets and assists banks in removing loans from their books as credit risk gets transferred to the investors. Now, let us discuss the different types of asset-backed securities. The first one is the residential mortgage-backed securities. The residential mortgage-backed securities are where the cash flow is derived from residential mortgages. These securities contain all of one type of mortgage or a mix of different types, such as prime and subprime mortgages. Prime mortgages are also known as high-quality loans, and subprime mortgages are loans with lower credit ratings and higher interest rates. These residential mortgages have the risk of default and a risk of prepayment, which impact the expected future cash flows. The residential mortgage-backed securities have a large number of small mortgage home loans that are backed by the houses as collateral. This makes the default risk quite low. Institutional investors, along with insurance companies, have long been a significant part in players in residential mortgage-backed securities. Residential mortgage-backed securities can be issued by government-backed agencies like Fannie Mae, Freddie Mac, and other private institutions and banks. Let us understand residential mortgage-backed securities with a quick consideration. Suppose a bank that gives out home mortgages has lent out total loans worth $1 billion distributed among thousands of borrowers. Clearly, the bank will receive repayments from these loans after 5 to 20 years. But to lend more loans, the bank needs more capital, which can be raised in different ways, such as secured bond issuance, unsecured bond issuance, or equity issuance. Another way the bank can raise capital is by selling the loan portfolio or a part of it to a securitization agency like Fannie Mae. However, due to their stringent requirements, the loans bought by Fannie Mae need to conform to high standards. Fannie Mae pools these loans based on their tenure and repackages them as residential mortgage-backed securities. Since now Fannie Mae backs it, it has a high credit rating of AAA and AA. The next type of asset-backed securities is the commercial mortgage-backed securities. Now, commercial mortgage-backed securities are backed by commercial real estate loans rather than residential real estate. These commercial real estate loans are given for income-generating real estate, which could be loaned for properties such as hotels, factories, apartments, office buildings, shopping malls, and warehouses. Just like residential mortgage-backed securities, commercial mortgage-backed securities are created when a lender takes a bundle of loans outstanding on its books, packages them, and then sells them in securitized form as mortgage-backed securities, very similar to bonds in terms of its cash flows. Commercial mortgage-backed securities are usually more complex because of the underlying property loan assets. In residential mortgages, we learned how the prepayment risk is quite high. In the case of commercial mortgages, it is not the same because commercial mortgages have a lockout provision and a significant prepayment penalty, which technically turns them into fixed-term loans. Commercial mortgage-backed securities issues have multiple tranches based on the cash flow risk. The tranches are created in a certain way so that senior tranches will bear the lesser risk, are given higher credit ratings, and provide lower yields. On the other hand, the junior tranche will bear higher risk generated from their cash flows from interest and principal payments and thus be given lower credit ratings and provide higher yields. To understand commercial mortgage-backed securities, let us consider another bank that gives out commercial mortgages and has lent out a certain amount of money for different durations across a diversified set of borrowers for commercial purposes. The bank again will sell its commercial mortgage loan portfolio to a securitization agency, which will bundle these loans into a pool and then create a series of bonds out of these termed tranches. Now, these tranches are created based on the loan quality and the risk associated with them. The senior tranches will have the highest payment priority, backed by high-quality loans of a shorter duration. Moreover, they will have lower yields. But don't forget about the junior tranches. The junior tranches will have lower payment priority. They will be backed by longer-term loans and will have higher yields. Rating agencies then assess these tranches. The senior tranches will have higher credit ratings falling within the investment grade of BBB- category. In comparison, the junior tranches with lower ratings will fall within the high yield of BB+ and below category. This gives investors the flexibility to choose the type of commercial mortgage-backed securities based on their risk profile. Large institutional investors with a low risk profile would prefer to invest in senior most tranches that are rated AA or AAA. Still, risky investors like hedge funds and trading firms might prefer lower-rated bonds due to the higher return potential. The third type of structured finance product is the collateralized debt obligation. With collateralized debt obligation, each branch represents a bundle of mortgages, and the tranches can have different interest rates and maturity dates. Again, it is different from traditional mortgage-backed securities. Collateralized debt obligations are a form of structured asset-backed security in which the individual fixed income assets, including residential mortgage and corporate debt to credit card payments, are pooled and repackaged into discrete tranches just like commercial mortgage-backed securities. Based on the riskiness of the underlying fixed income assets and are then sold into the secondary market. The risk profile of different tranches carved out of the same set of fixed income assets could vary substantially. The tranches are given ratings by different credit rating agencies based on the risk they carry. Again, the senior tranche is assigned the highest rating of AAA as they carry the lowest risk, though with lower yields. The middle tranches with a moderate risk, rated between AA to BB, are known as a mezzanine tranche A, which leaves us with the bottom tranche, which has the lowest rating or remains. Unrated as they carry the highest risk with the higher expected yield. Now, if the loans in the pool start going into default, the equity tranche will be the first to take losses, and the senior tranche might remain unaffected. An interesting aspect of collateralized debt obligations is that they can be created out of any fixed income asset, which could even be other collateralized debt obligations. So, for example, it is possible to create new collateralized debt obligations by pooling subprime mortgages or equity tranches of numerous other junk-rated collateralized debt obligations, and then creating a senior tranche from these collateralized debt obligations, which will have a substantially higher rating compared to the underlying asset. The actual process is a lot more complicated, but we guess you get the idea of how it works. Remember, this was a common practice during the pre-financial crisis years and had a major role in the creation of the asset bubble. The subprime mortgages, in a way, became fuel for the creation of such securities and were being disbursed to anyone and everyone without requisite due diligence. Having said that, we arrive at the last type of structured finance product, which is collateralized loan obligations. The collateralized loan obligations are managed by a manager who buys half of all leveraged loans, establishes a special purpose vehicle, and then creates a capital structure comprising different tranches. All these tranches have different credit ratings, typically varying from AAA to BB. After this, the manager carefully starts buying tranches of assets that match the risk-return expectations of their investors. This is also known as the warehouse period, after which there is a ramp-up period in which the collateralized loan obligations manager buys further assets using the issuance proceeds. The period is followed by the reinvestment period, in which the manager trades assets, and then comes the post-reinvestment period, also called the amortization period, in which the manager pays off the outstanding notes. Throughout the entire life cycle of collateralized loan obligations, the capital and interest payments received are used to pay the collateralized loan obligations to managers' investors in line with the structure's cash flow. With this, we have covered all the four major types of structured finance products. Now, we can explore all the different types of risks and challenges associated with these products in the next module.